Consider this scenario for a moment. You have $100,000 sitting in your bank account. You walk up to an ATM and withdraw $10. Would you call everyone you know in a state of alarm and tell them your financial life is unraveling? The suggestion is almost laughable. No rational person would frame a $10 withdrawal from a $100,000 account as evidence of financial distress. And yet, that comparison, in terms of sheer mathematical proportion, mirrors almost precisely the size of the event that sent shockwaves through the entire cryptocurrency market this week and persuaded thousands of XRP holders that everything they had patiently built was suddenly at risk. So the genuinely important question here is not what happened. It is something more interesting and more useful. How does a $10 event produce the kind of fear that convinces grown, intelligent, experienced adults to abandon positions they spent years protecting? Because the fear you experienced this week was not accidental. It was not a side effect of circumstance. It was a product, carefully constructed, precision-engineered, and delivered directly to the emotional center of people holding exactly the assets you hold. I am not raising this to amplify your anxiety. I am raising it because the moment you can see that mechanism clearly, it loses its power over you permanently. The instant you recognize the architecture of manufactured fear, the whole apparatus becomes transparent, and you begin reading every financial headline the way the one person in the room who cannot be fooled would read it. So let us begin with the actual numbers. Because once those numbers are in front of you, the entire narrative that was built around them begins to dissolve on its own. For years, there has been one name in this industry synonymous with a single, unwavering conviction: Michael Saylor. His company holds more Bitcoin than any other corporation on the planet, a position running into hundreds of thousands of coins. Over time, Saylor did not simply become a large institutional investor in Bitcoin. He became a philosophical anchor for an enormous portion of the market's belief system. His public commitment was simple and absolute. He would never sell. He would only accumulate. And that posture transformed into something that functioned more like a shared creed than an investment thesis. When Saylor spoke, markets paid attention. When he bought, the headlines followed. Countless individual investors quietly built the foundation of their own conviction on top of his, treating his certainty as a kind of borrowed confidence. So, when a regulatory filing surfaced this week showing that his company had sold a portion of its Bitcoin holdings, the reaction among market participants was immediate and visceral. The interpretation that spread fastest was also the most alarming. The most committed holder in the space had broken ranks. The philosophical pillar had cracked. If Saylor was selling, what did that signal about what was coming? Here is precisely where the story reveals itself to be something far smaller than the reaction it generated. The quantity sold was negligible relative to the total position. We are back to that ATM analogy, a $10 withdrawal from a $100,000 account, a sliver of a position that remains, by any reasonable measure, one of the most concentrated and committed corporate Bitcoin holdings in existence. And the motivation behind the sale was about as operationally mundane as financial transactions get. The company liquidated a small amount to cover routine costs associated with running the business. This is not a strategic exit. This is not a shift in long-term conviction. This is the financial equivalent of transferring a modest amount from a savings account into a checking account to make sure the monthly bills are covered on time. Every analyst who examined the filing with any degree of rigor arrived at the same conclusion. The transaction was financially immaterial. It communicated nothing meaningful about the long-term strategic posture of the company, and nothing of substance about the broader supply dynamics of Bitcoin itself. I want to be straightforward with you here, as I always try to be. I am not here to tell you what Bitcoin will or will not do. That is not this channel's purpose, and nothing said here constitutes financial guidance of any kind. What I am doing is placing a specific number directly beside the reaction that number produced and inviting you to look clearly at how enormous that gap is. Because that gap, the distance between what actually occurred and the emotional magnitude of the response, is the entire mechanism we need to understand, which raises the question that should genuinely trouble you. If the underlying event was that modest in scale, what force was capable of transforming it into something that felt catastrophic? The answer is a business model. Here is something that took honest reflection to fully internalize. The financial media does not generate revenue from your peace of mind. It generates revenue from your engagement. And the single most reliable driver of human engagement, the thing that makes a thumb move toward a screen faster than almost anything else, is fear. Sit with that reality for a moment, because once you have genuinely absorbed it, you cannot observe financial media coverage the same way again. Tranquility is commercially worthless to that ecosystem. A composed, well-informed reader who scans a headline, recognizes it as noise, and returns to their daily life without clicking generates nothing for that machine. But a person whose pulse quickens at midnight, whose thumb taps the notification reflexively, whose anxiety keeps them scrolling for the next update, that person is the entire revenue model. The fear you feel is the product being sold. Now watch how that mechanism operated on our $10 event. A small, routine, operationally motivated sale became raw material. The framing that emerged from that raw material included questions about whether Saylor had lost faith in his own thesis, whether a market top was forming, whether the most iconic holder in the space was quietly repositioning toward the exit. Every one of those frames was constructed around a kernel of factual truth. And every one of them was engineered to bypass your analytical thinking and register directly as a physical sensation in your chest. The amplification does not stop at a single headline either. Larger funds respond to price movement by rebalancing their portfolios. Traders who entered positions using borrowed capital face forced liquidations when prices pull back. Cryptocurrency markets begin correlating with an already unsettled equity market. And suddenly, a week that was fundamentally quiet in terms of real fundamental developments looks and feels like a systemic crisis, because every data point is moving in the same direction simultaneously, and every caption accompanying those data points is written in the loudest possible register. I want to be careful about the claim I am making here. I'm not constructing a grand unified conspiracy theory or suggesting that I have complete visibility into the motivations of every participant in every transaction. What I can describe is the observable shape of what occurred. This sell-off was not the result of a technological failure. The underlying infrastructure did not break. No foundational investment thesis collapsed. What happened was noise wearing the costume of a crisis, packaged for commercial distribution. Those are the strings I mentioned at the outset. They are now visible. But this observation leads to another question worth examining with equal seriousness. If the event was genuinely this small, and if the amplification mechanism is this transparent once you know to look for it, then why do so many patient, intelligent, long-term investors still get shaken out when it happens? The answer to that question has almost nothing to do with financial analysis. It has everything to do with human psychology. People generally prefer to believe they exit positions based on rational information, a data point that shifted, a chart that sent a clear signal, a number that moved beyond an acceptable threshold. I think the honest truth is considerably more personal than that. When an investor lacks a clearly defined, deeply internalized sense of their own identity as a holder of a specific asset, every frightening headline functions as a direct personal challenge. Without a solid foundation of understanding beneath them, the fear finds something to grip. A person reads that the most prominent Bitcoin holder sold, and somewhere in the quieter recesses of their thinking, a voice suggests that perhaps there is information being acted on that they do not have access to. And the response that follows is not a logical conclusion. It is something closer to social anxiety, a fear of being the one person in the room who missed the signal everyone else caught. Now contrast that experience with the person who spent time actually understanding why they own what they own before they owned it. That person encounters the exact same headline and experiences something entirely different. A modest, operationally motivated sale does not threaten them because their conviction was never derived from Saylor's confidence in the first place. It was derived from their own analysis of the problem the asset is designed to solve, the technology, the infrastructure, the use case, the trajectory. No stranger with a platform and a microphone can argue them out of a position that they arrived at through their own understanding. And here is what I find genuinely encouraging about all of this. The capacity to hold a position from that kind of grounded understanding is not a fixed trait. It is not something you either have or you do not. It is a skill that develops through deliberate practice. You do not need to become an economist or a technical analyst or a market structure expert to get there. The investors who navigate these moments most effectively are not uniformly the most intellectually sophisticated people in the space. They are the people who have developed the discipline to remain steady with their own emotional responses. That is the entire capability. It is acquirable by anyone willing to put in the practice. Now let us make this specific and personal, because if you are holding XRP, there is a particular dynamic operating in your situation that deserves direct and honest attention. There is a structural vulnerability that catches XRP holders repeatedly, and most of the people caught by it never see it clearly enough to understand what happened to them. Here is the reality of your position that is worth acknowledging plainly. You carry a form of emotional exposure that Bitcoin holders, as a general category, do not carry to the same degree. And this is not a reflection of any weakness in your judgment. It is simply a structural feature of how these markets interact. When Bitcoin experiences a significant decline, altcoins tend to amplify that decline. The correlation is not perfect or universal, but the pattern is well established. That structural relationship means that a news story about Michael Saylor, about a company you may have no position in, about a coin you may never have owned, can produce a meaningful drawdown in the asset you have held with patience for years. And that is where the trap operates most effectively. The price of XRP falls not because anything fundamental to XRP changed, but because of events entirely external to XRP's own story. Consider what that dynamic actually demands of a long-term XRP holder. You held through extended periods of sideways price action. You held through cycles of optimism followed by prolonged silence. You maintained your position through regulatory uncertainty, through the long shadow of the SEC lawsuit, through the periods where the silence from the broader financial world felt the loudest. You did everything correctly. You survived the hardest parts. And then, in a week like this one, you reach a breaking point and sell, not because of anything that happened to XRP, but because a headline about someone else's Bitcoin triggered a fear response that the market structure dutifully amplified into a real price decline. That is the full architecture of the trap. Surviving the most difficult stretches of the long-term hold, then surrendering the position at a depressed price in response to a fear event that was never actually about you or your asset. Seeing that clearly and completely from the outside is the beginning of not being caught by it again. So let me offer you the practical exit from that pattern, because there is one, and it is not complicated. The exit is to anchor your conviction to something more durable than price movement and more personal than someone else's public declarations. Anchor it to the actual reason you invested in the first place, the specific problem this technology was built to address, the way value moves across borders, the slow, methodical, unglamorous process of building financial infrastructure that works at institutional scale, the regulatory trajectory, the growing list of serious institutions whose own actions reveal that they take this infrastructure seriously. When your foundation as a holder is constructed down there, at the level of genuine understanding of the asset's purpose and trajectory, a headline operating at the surface level does not have the reach to disturb it. The surface and the foundation are simply too far apart, and I want to say this with genuine warmth rather than clinical detachment, because the emotional dimension of this matters. Developing that kind of understanding is not a passive process. It is something you actively build, incrementally, through consistent attention and honest learning. Every week, you spend deepening your understanding of why you own. What you own makes you measurably harder to scare the following week. Given enough time and enough practice, you reach a point where a headline that previously would have triggered a physical anxiety response simply registers as noise that does not apply to you. That is not an idealized outcome. It is a practical one, and it is available to anyone who does the work consistently. Let me now move from the psychological framework to the operational practice. Theory without application does not change behavior. So, what does this actually look like in the moment when the screen turns red and the headlines are at their loudest? Here is a simple two-question process that cuts through almost all of the noise with remarkable efficiency. The first question is this: what specifically and factually occurred here? Remove all the framing language. Strip away the characterizations. Find the bare, unadorned fact underneath the presentation. In this week's case, that fact was, a company sold a small quantity of Bitcoin to cover operational expenses and reported it in a regulatory filing. That is the complete factual content of the event. Everything else was editorial construction. The second question is, does this event change anything that is genuinely fundamental to my investment thesis? Not anything that sounds alarming. Not anything that moves the price in the next few hours. Anything real. Did the underlying technology fail? Did the core use case become invalid? Did the regulatory and institutional environment fundamentally reverse? Did the reason I originally chose to hold this asset cease to apply? When those two questions are asked clearly and answered honestly, the answer to the second one is, in the overwhelming majority of fear events, a quiet and almost anticlimactic no. A verified security breach is a real event. A confirmed technological failure is a real event. A legislative outcome that genuinely closes the doors that were opening is a real event. Institutional funds executing routine portfolio rebalancing, leveraged traders being liquidated as prices move, a nervous broader equity market creating correlated selling pressure and amplified headlines designed to maximize emotional impact. That is weather. It is temporary atmospheric conditions. It does not alter the terrain underneath. And here is the reframe I want to leave you with, because it genuinely inverts the way most people experience these moments. For the investor operating with a long-time horizon, fear is not the enemy. Fear, expressed through widespread selling, is the mechanism through which discounts become available. The construction of meaningful long-term positions tends to happen during the sell-offs, during the pullbacks, during the periods when the crowd is moving toward the exit and the media captions are at their most alarming. I want to be precise about what I am saying here. This is not an encouragement toward recklessness or an argument against prudent risk management. It is an observation, backed by the pattern of market history, that the sessions generating the loudest headline fear have often been the sessions where the long-term buyer quietly found the most favorable entry point. 2 additional points before we close, and both deserve to be heard honestly. The first is about your personal financial foundation. None of this applies in a useful way if you do not maintain adequate cash flow in your own life independent of your investment positions. Waiting for an investment outcome to resolve financial pressures that exist in the present is a posture that creates dangerous vulnerability. Build and protect your income. Maintain financial stability that does not depend on what a price chart does this week. When you have that stability, a market discount becomes an opportunity. Without it, the same discount can become a crisis that forces your hand at the worst possible moment. The second point is about the specific cost of fear-driven selling in a taxable account. If you exit a position in a panic and you are sitting on a realized gain, the consequences compound in a way that people rarely calculate in the moment. You do not only lock in a lower price than your original thesis supported, You may also trigger a taxable event that delivers a portion of that position to the tax authorities. Fear extracts a cost at the moment of exit. The tax system may extract an additional cost immediately afterward. Composure is not only the emotionally healthier choice, it is frequently the less financially expensive one as well. And one final observation, offered with sincerity rather than alarm. A genuine crisis will arrive at some point. Not this week's $10 event, which was noised by every meaningful measure, but a real one. A development with actual structural weight and genuine implications for the long-term thesis. The reason it matters so much to stay composed through the small events, through the manufactured fear cycles and the amplified noise, is that doing so is practice. Deliberate, cumulative practice for the moment when the test is real. The investor who has trained their responses through 100 small, noisy episodes is dramatically better equipped to think clearly and act rationally when the stakes are genuinely high. The one who has spent those same episodes caught in reactive fear has not built that capacity. The quiet discipline of staying calm now is direct preparation for staying capable later. A man sold $10 worth of a $100,000 position, and an entire asset class experienced a fear response disproportionate to that event by every rational measure. Not because something broke, not because any fundamental thesis collapsed, because fear is a marketable product, and the people who produce and distribute it are skilled at their work. But the product only works if you buy it. And you do not have to. You can be the person in the room who reads past the framing, identifies the underlying fact, asks whether anything genuinely changed, and returns to building a life while the noise plays out around them. Not because you have trained yourself to be without emotion, but because you have learned through practice and honest reflection to distinguish between weather and terrain, between noise and actual news, between a $10 withdrawal and a $100,000 emergency. That distinction is why this channel exists. Not to be one more voice adding volume to a conversation that is already too loud, but to offer you a reliable way back to your own clarity, one honest analysis at a time. Tell me in the comments whether you have ever made a panic-driven sale. I have. Most people who have invested long enough honestly have. The difference between where we were when that happened and where we stand now is not superior intelligence. It is accumulated practice at staying steady. That practice is available to all of us, and it compounds just like any other kind of capital. Stay patient, stay grounded, keep your hands steady. I will see you in the next one.